Everyone over 35 is walking into 2026 with the same hidden risk. Almost all of their money is sitting in the wrong place for the demographic shock that's coming. Over the next 18 months, an estimated $68 trillion in wealth is going to start changing hands as aging baby boomers and the silent generation liquidate assets or pass them on. Most of that wealth today is concentrated in stocks, bonds, retirement accounts, real estate, and private businesses, and roughly 80 and 90% of all investable assets are held by people 35 and older. When that group panics, retires, downsizes, or is forced to sell, the people over 35 who don't understand what's coming will see their net worth quietly drained over a decade. Not in a dramatic market crash, headline tomorrow way, but in a slow, grinding, silent wealth extraction that leaves them wondering why they did everything right and still ended up short. This video is about how not to be one of them. What's actually happening in 2026 and why it targets 35. Think about who owns what. Boomers and older generations are expected to pass on roughly $68.84 trillion in assets in the coming decades, with much of that process accelerating in the late 2020s. That wealth is heavily concentrated in equities, real estate, and small businesses, not cash. At the same time, a large cohort of those owners are hitting ages where required minimum distributions, RMDs, and retirement withdrawals are forced healthcare shocks, and long-term care needs require sudden liquidation widows. Heirs and executors sell what they don't understand, who's on the receiving end of this. People in their late 30s, 40s, 50s, and early 60s, if you're watching this channel who already hold the majority of investable assets and are heavily tied to their home equity, their 401 HIRA portfolio, the valuation of their business or practice, that concentration means when boomers sell in size, it's not someone else's market that gets hit. It's your portfolio, your house price, your business multiple. The default outcome, if you do nothing, lower long-term returns from crowded, over-owned assets, compressed valuations on the businesses you plan to sell, a housing market where a wave of older sellers meets fewer younger buyers at current prices. Everyone over 35 loses money by staying positioned exactly where they are now. Unless the silent wealth extraction, most 35 investors never see market crashes get headlines. What doesn't get headlines is the slow math of demographics and forced selling. Here's what that looks like. Older households liquidate stocks and funds not because they're bearish, but because they need cash. Executors and heirs sell inherited real estate and business interests because they don't want to manage them. Capital flows out of broad indexes, expensive real estate, and illiquid private companies into cash annuities, safer fixed income. The result is a long period of mediocre or negative real returns in the very things over 35 investors are most overweight. Think equity indexes that churn sideways or underperform for a decade, in real terms housing that looks stable nominally but loses ground after inflation and carrying cost private business valuations shrinking from till to 4 times exabytes at toward 1.5 fit 2 times in many aging. Owner-dependent industries, a supply of sellers overwhelms buyers. That's the silent extraction. The market doesn't crash so dramatically that you change behavior. It just sits on your money while inflation quietly walks off with your purchasing power. You're still invested. You still feel responsible. You just don't realize the game board shifted underneath you. Why a house can be your biggest liability in this environment. If you're over 35, there's a high chance your largest single asset is your primary residence. In a demographic environment where millions of older owners will eventually need to sell or downsize, younger generations face affordability constraints, and debt housing markets in many regions are already priced at 6 to 10 times H household income. Your home behaves less like a growth asset and more like a slow, illiquid bond with property tax obligations. Maintenance risk, local economic risk forecasts aren't identical across all markets, but many long-range analyses expect meaningful pressure on home prices and volumes in aging, slowy growth regions heading toward the 2030s. If your retirement plan quietly assumes, I'll sell this house at a higher price and downsize, my equity is my safety net, then you are, by definition, depending on a market where a shrinking base of younger buyers must absorb an expanding wave of older sellers. That's not a great trade. The house isn't evil. It's just not the wealth engine people over 35 have been told it is. The 40% cash discipline and why it's not hiding. What does someone like Warren's style thinking do in this environment? Not panic, not sell everything, but also not stay fully exposed. The idea of a 40% cash discipline is simple. Keep a meaningful chunk, say 30-40% of your net investable wealth in high-quality, liquid, low-risk instruments, treasury bills, and money market funds, short-term government bonds, high grade. very short duration fixed income. Why? Because in a period where demographic selling pressures, high valuations are still elevated in some sectors, the probability of sharp dislocations is higher than normal. Cash is a call option on future opportunity. It lets you buy quality assets when others are forced to sell. It protects you from being a forced seller yourself. It gives you psychological freedom to act rationally. When prices move, the point is not sell everything and sit in cash. The point is, do not walk into 2026 with 100% of your net worth locked into aging assets that could face a long period of compression and forced selling. The three types of assets that can actually benefit from this shift, while broad, over-owned assets may drag. There are categories that can benefit from aging demographics. Liquidity needs capital rotation, think in themes. Not tickers, assets that serve an aging population but are operationally lean. Select healthcare, home care, medical technology, and senior services that don't rely on heavy real estate exposure. Businesses and securities that buy from forced sellers, distressed asset buyers, consolidators, roll-up platforms, and certain REITs or funds specifically structured to acquire from aging owners at discounts. Highly productive, cash-high generating businesses with low capital intensity companies, public or private, that can compound earnings without constant reinvestment in hard assets. And that benefit from lower acquisition multiples as demographics force sales. The point isn't to guess a hot stock for 2026. It's to own the kind of assets that sit on the right side of a $68 trillion transfer, not the wrong side. Exact 30-day action plan for over 35 investors if you're over 35. Here's what to do in the next 30 days. Before 2026 drags you along with everyone else. Map your exposure list, your assets, home equity, retirement accounts, brokerage, business equity, cash for each. Ask, who will be the natural buyer of this in 10 to 15 years? Raise strategic liquidity, target a 30-40% cash or near cash buffer across your investable net worth. This doesn't mean panic selling quality at any price. It means trimming excess and over-concentrated, overvalued positions and reducing reliance on a single asset like your house or company. Reallocate deliberately, gradually, tilt away from overpriced, over-owned, fully valued exposure, single-point failure assets. One property, one business, one employer, tilt toward liquid. Cash-generative assets, vehicles that can take advantage of distressed selling over the next decade stress. Settist. Your plan asks, if my house fell 20-30% in real terms, my business sold for half the multiple I expect, and my equity portfolio delivered flat real returns for 10 years, can I still retire on time? If the answer is no, your 2026 plan needs adjusting now, not in 2034. How to turn the 2026 setup into a 5-10 times wealth opportunity. The same forces that will quietly drain wealth from most over 35 investors can multiply wealth for a small minority who hold more cash when others are fully invested. Understand that demographic selling and forced liquidation are not end, but the sale are psychologically prepared to buy high-quality assets from sellers who have to sell, not want to sell. That's how. Business buyers acquire companies at 1.52 times exabytes ITA that used to trade at 4 times investors buy quality real estate or securities at yields that were unthinkable just a few years earlier. If you're over 35, your default path is to be on the selling side of that trade through your retirement accounts, your house, your future business exit, unless you deliberately reposition now to be on the buying side when the demographic math forces others out.